Would you all mind introducing yourself? If we go down the panel, you could just say your name and where you're from, et cetera. Pete, we'll start with you.
Pete Carroll, public policy at CORELOGIC.
Andy Davidson of Andrew Davidson Company.
Jeremy Switzer, I head up the product and pricing strategy group at PENNYMAC Loan Services.
Lindsay Johnson, the president of U.S. Mortgage Insurers.
RAJIV, KAMILLA, head of mortgage asset finance, Goldman Sachs.
Larry Platt, I'm a partner at Mayor Brown in Washington, D.C.
So we've got a good cross-section of the ecosystem here to talk about sort of how to build some self-governance for the PLS market. Now, we've talked about this a little bit, but you know, the GSE space, I think everybody can agree that with a stronger regulator in the form of FHFA, as well as two institutions that do a lot of standard setting, there's probably the best thing that's happened in the 10 years since the financial crisis has been the governance of the agency market and the ability to actually have standardization and have some governance and to make sure that market functions pretty well. You know, the PLS market has not returned, at least anywhere near the size that it was prior to the financial crisis. And yet there's this moment now where regulators seem to be intrigued by the idea of trying to bring it back on some level. So if you just go down the list of regulators, you've got the FHFA saying that they want to shrink the GSE footprint on some level, but they obviously are not allowed to do that and massively restrict mortgage credit for obvious reasons. The CFPB has announced that they're going to end the patch. So that's part of this footprint reduction sort of narrative that I think exists. And the SEC, with some degree of prodding, we're not sure how much, but some degree of prodding from the other regulators has said that they were willing to look at the Reg AB2 requirements and whether a reexamination of some of the data fields that are required in Reg AB2 is something that merits their attention. So you have this moment where there are three regulators who matter saying we want the PLS market to come back. And so for the Structured Finance Association, it feels like, hey, we're supposed to care. But not only do we want to be part of having a dialogue with those regulators to help them make sure that they establish rules that can allow for this market to thrive, but we think that borrowing from the lessons in the agency space of building industry self-governance is something that's going to be critically important. And so this is an objective for us as this thing moves forward. And while the rearview mirror looking at the PLS numbers maybe aren't inspiring because you're talking in the tens of billions, not hundreds of billions or trillions of dollars a year, the fact that you have these three serious regulators taking this serious of a look at it means that we have, I think, and this is the moment to step in to say, let's make sure we get it right. So that's kind of the background. So we'll jump in with our panelists. Pete, you know, we were talking about QM and ATR. You were at the CFPB. I think, is it true that everybody who loves Appendix Q can thank you for that, or?
Yes.
Okay.
I get
thank
patted
you,
on the back.
Yeah,
all the
yeah,
time
no,
for
it's
that.
a home run. It's a joke. But give some background on sort of ATR, the purpose of ATR, the safe harbor, purpose of safe harbor, and you know, what was that about, and how should we think about these changes that are coming at us now?
Sure, happy to. And obviously it's important to, actually this is great because I feel like this is my opportunity to like make excuses for any bad decisions.
Sure.
So thank you.
That's
for that.
great. We're happy to help.
So this is good. So no, but you know, certainly the way when we were doing this the first time around, very different market, very different set of drivers and considerations and principles to the rulemaking. Just, I'm sure most of the people in this room by now know what this rule is, so I won't dwell on it too much. But you know, the ATR, and Larry always does 100 times better job than I do explaining it because he's actually an attorney. But you know, ATR at its core, that's a foundation. Creditor must make a reasonable, good faith determination that the borrower will repay their loan based on verified and documented information, and that really kind of boils down to 8 factors. I don't need to go through all of them. You know, credit history, you know, current income, expected income, employment. Importantly, financial resources like assets that don't include the equity of the consumer in the home, and DTI or a residual income test. And the creditor has to document, verify, consider these 8 elements under the ability to repay requirement. Failure to do so subjects them to liability under TILA. That liability can be in the form of CFPB enforcement or consumer litigation. Consumer can sue the creditor, and for the first time under this rule, the assignee. the end investor, even in the security, can be exposed to that liability, which is interesting. And then just the idea behind the QM was to say, and this is where things get a little challenging and labels matter in my view, but qualified mortgage was meant to say here's a safer loan construct, which boils down to really to three things. It can't be neg-am, can't be a negatively amortizing loan, has to be fully documented, cannot have points and fees exceeding 3%. If you stay within these guardrails, that's deemed to be safer, and that can give you some protection from this liability under ATR. You're presumed to comply with ATR if you do the qualified mortgage. It wasn't meant to imply that ATR lending, non-QM lending, was inherently bad. That wasn't not at all meant to imply that there could be plenty of good non-QM loans to do, but you're just not going to get relief from this liability under ATR if you do them. That's really all it was meant to say, and I think we were talking about this in the speaker ready room, that the non-QM label has been somewhat unfortunate in that respect. But just in terms really quickly of the first go-around, just probably some of the things I'd point to, very different market. You gotta remember this back in 2012, mandatory deadline to have the rule done by January of 2013. Back then, if you'll recall, the GSEs were gonna be wound down, was all the rage. Private capital was unclear how and where and when it was gonna allocate. There was tons of litigation going on, government litigation, counterparty litigation, repurchase demands, and then there was the introduction of this assignee liability that was new and frightening. And then on top of that, you had a very challenged rulemaking process. So something a lot of people don't know is the CFPB actually inherited a proposed rulemaking, completed proposed rulemaking from the Federal Reserve Board. So with 6 months on the shot clock and a proposed rulemaking already completed, there was this task of how do we try to cobble together something that will work and just frankly not blow up the market would be a good thing if we were successful at that. And so we kind of just sat down some principles for the kind of first go around given these constraints. The first was that the QM had to be just when it all washed out, lots of different points of views, but when it washed out, there was a view that given where the markets were in terms of still kind of healing themselves, recovering, the QM needed to be broad and the QM needed to be clear. That was kind of one principle. The second was to really prioritize what the issues were from the financial crisis that were going to attempt to be addressed. And it was kind of deemed that Alt-A was obviously a huge contributor. And so kind of making sure that full documentation was a component of the QM and that was something that everybody was doing was deemed important. There was a perception that negatively amortizing loans were confusing to many borrowers and were kind of pushed on borrowers who didn't understand how they behaved. I actually will say I saw a lot of testing at the CFPB that persuaded me that that can be true. Not always, but can be. And then this new notion that subprime lending can be good, but we really should be pushing QM loans for subprime lending where there are these guardrails built in that kind of make it safer. Then the question became what kind of protection are we going to offer for people who choose to do QM loans? And it just kind of naturally fell in. Another thing most people don't always, I get a sense most people don't realize is that the Federal Reserve Board put in the first federal ATR rule in 2010 that said if you are a higher price mortgage loan where the annual percentage rate is less than the average prime offer rate plus 150 basis points, if you're above that threshold, you were subject to HOPA liability. So there was already this notion of a pricing threshold that existed even before the ATR QM rule. And there was a lot of debate about should the QM be a safe harbor or not be a safe harbor? And it did kind of land, I felt somewhat rationally on this notion that when it comes to, if you're talking about a QM loan with these kind of three basic features to them that are prime priced, you probably are in a pretty good space to offer a safe harbor. If you're above that, you probably want to give some ability for the consumer to rebut what would otherwise be a conclusive presumption. So meaning if you are a safe harbor, that's conclusive. The borrower cannot sue you other than on the grounds that the loan is not a QM in the first place. But if the loan is deemed a QM by a court, that's it. It's done. It's conclusive. If it's a rebuttable presumption loan above that pricing threshold, there was retain a narrow ability for the borrower to rebut that presumption in court on the grounds that there was not enough residual income. So I'm going to kind of just keep going. I just wrap this up by saying, so why did we get this patch, this 43% DTI? The best way I can describe it quickly would be to say that given all those constraints I described, it was that the attorneys felt like we had very limited options, and the best option was to take any pre-existing widely accepted standard that existed and use that in the rule. And there was a feeling that if we were going to, given where we were at the time, that if we were going to provide a QM safe harbor fresh out of the financial crisis, there had to be some level of underwriting overlay on top of those three features that I described in the QM. And that's where things got really tricky and very difficult. And when we surveyed the landscape, the choices were minimal. We had the GSEs and their automated underwriting systems and the seller servicer guys that went with them. And we had FHA and VA and the notion that you had a manual underwriting back-end debt-to-income ratio of 43% DTI, and a view that we really had to kind of hew to the statute given that we didn't get a chance to put out a proposed rule. So therein lies why we have today a baseline general definition of a 43% DTI, an Appendix Q, which was pulled straight out of the FHA underwriting guide, and then a GSE patch, which was meant to be temporary, that said, at least for the next five years once we go effective, you can use the GSEs as an alternative if it's eligible for that purchase or insurance by the GSEs, you get that QM stamp.
So tricky rulemaking. So now we're moving into this post-patch and presumably post-43 DTI and post-Appendix Q world. It seems like the CFPB has made clear that this is likely where we're going, but you can get rid of the patch, you can get rid of 43 DTI, and you can say APOR is going to be a threshold that we're going to use in some way to determine the safe harbor, which seems to be where things are going. That said, the statute does still require the verification and consideration, I think the words are verify and consider, a borrower's income and their ability to repay. So Larry, you're the attorney here. What maneuverability do we have given the limitations of the statute on the verify and consider? How do we think about a post-Appendix Q world where that's still going to be in the law?
Well, the consider element, I mean, the way I think of it is there's document income, and that applies whether it's QM or non-QM. Document income and assets, verify, which is I think of as loan processing essentially. That's true whether it's non-QM or QM. The non-traditional loan products, that's just to get out of, or to be able to be in QM. But then you've got this underwriting element, and that consider, so if you have document, verify, consider, underwrite. Consider and underwrite are in the statute as it relates to ATR generally, but it's not in the statute as it relates to QM. So the Bureau actually has the discretion to completely eliminate any kind of an underwriting requirement if it wants to. So if it wants to get rid of the GSE patch, if it wants to get rid of the 43% DTI as defined by Appendix Q or determined in accordance with Appendix Q, the statute lets them do that. And so the debate that's going on right now is really twofold. First, should there be any replacement for the patch and the 43% DTI, and if so, what is it? And where should price come into the picture? So with respect to the first one, there seems to be a difference among the players as to what they'd like to see. Some still want to have a debt-to-income ratio requirement. It's an objective requirement, more or less. They'd like it to be more flexible, such as to have an increasing DTI requirement based on the presence of various compensating factors. Some people would like just to have price instead of DTI on the premise that, according to Urban Institute studies, price is a better predictor of borrower default than DTI. Some want to have an ill-defined or undefined underwriting requirement, which simply says you shall consider those various underwriting elements without telling you how to consider and what the relative weights are. And the idea is that that would give more flexibility to the industry to innovate without prescribing a certain method, which may be out of date by the time it's done. And of course, the problem with that is that if you're actually in an enforcement action or litigation, you're open to the question of whether you properly considered, if considered in and of itself doesn't have a definition. And so now one of the ideas going around is that rather than saying you have to consider, you have to document how you considered. So it's really whether you considered, not how you considered. And that would be a more objective test. So that's really one of the big pressure points right now. And as it relates to price, as I said, it could replace an underwriting requirement or it could be an overlay. And what I'm hearing is that price will not be used as an alternative to underwriting, but instead it may just be a cap. So if you get to the over 150 plus APOR, you hit the rebuttable presumption. And then if you hit a higher amount of a certain number of points over APOR, then it's a hard stop and you go into non-QM land. And then just lastly, there's 3 consequences to this, separate and apart from whether you decide a loan is QM or not QM. The first is QRM. So remember the risk retention rules rely presently on the definition of QM. A qualified residential mortgage is defined the same as a qualified mortgage and is exempt from risk retention rules. So if you dilute the underwriting requirement in QM and it automatically carries over to QRM, then in effect you would get rid of the risk retention rules for loans as to which there's not an underwriting requirement. It doesn't have to be that way, but that's one thing. And then the second issue that I think comes up a lot in terms of the spillover consequences is what impact does this have on the non-QM market? If you get rid of any type of an underwriting requirement, what's left for non-QM other than price and non-traditional loan products? Price in terms of points and fees and price in terms of spread over APOR. So those who want a really vibrant non-QM market, the two are inextricably tied together. The broader the QM market is, by definition, the narrower the non-QM market's going to be.
Yeah. Now, that space in between, so Rajiv, you guys have looked at non-QM today. We know what the definition of QM is evolving. We know that there are some elements of the ATR definition that are evolving. And we focused a lot on the safe harbor, but I think, in conversations you and I have had, you get very focused on the ATR, meaning please tell me what is an illegal loan so that I make sure that I'm not entering any financing, purchasing that. How important is some certainty around this is a line you cannot cross as for an investor and in a securitizer perspective?
Look, sorry for my voice. Look, ability to repay is clearly a pretty important tenet for responsible lending, and I think we can all agree on that. And Pete and Larry sort of walked through sort of the history and sort of what some of the regulations were intended. And if you look at the broader sort of lending markets, I think in a lot of markets, people do try to be responsible lenders. And those who finance them effectively try to understand that and how responsible lending is meant to be conducted. The issue we have here is in this mortgage market, and unfortunately took a financial crisis to get there, the principles of ATR are essentially principles. There is no implementation guide as to how this is meant to be applied. And the key issue here is if you get it wrong, you're liable. And liability travels from the lender to whoever effectively provides capital and liquidity to that asset. It travels to bondholders, as you heard Larry say. It travels to whole loan buyers. And neither of whom are really in a great position to assess if ATR was actually complied with. They can probably get comfortable that maybe it was intended to be ATR, and we were actually joking in the speaker room that maybe that's what it should really be saying. It was maybe intended for ATR, but nobody can give you definitively that something actually complied with ATR. You can give a good faith intent that they intended to. Now, what are the implications of that? I think the implications of that are manifold. One, on the borrowers, they are probably not getting access to credit in certain cases where, but for there being a clear-cut guidelines for ATR and how that should be implemented, lenders would probably have been willing to provide them with loans. So it's probably constraining access to credit. Because today, a lot of the discussions that I run into with other lenders and capital markets provider, they conflate good credit with ATR, and those are fundamentally different things.
Yeah.
Clearly, if you make responsible loans to somebody who has great credit, low LTV, will never default and never run in trouble, and ATR never gets tested. ATR only gets tested when presumably somebody ends up not being unable to make good on the loan. And so lenders effectively, I think, are conflating the two to be on the safe side. There are a lot of large investors who presume, I think based on our conversations, who probably stay on the sidelines because of this ambiguity around ATR. So look, I mean, again, I don't think anybody will debate that ATR is a very, very responsible thing for the lending industry to have. And it is unfortunate that a very good principle has associated liability without having implementation guidelines that are very clear-cut for the industry to follow.
No, it makes a lot of sense, and it's particularly important if we're going to rely on a non-GSE market to fill the space that collectively between whatever pricing threshold, but clarity around verify and consider, clarity around what isn't allowed, that we get that so that we actually can bring capital to bear in this
So
market.
I will actually add to that. You know, there are high-cost rules, for example. There are federal rules and state rules. They're very clear-cut. Somebody looks at a high-cost loan, they know if it's a high-cost loan or not. I don't think there's an ambiguity in whether a high-cost loan is a high-cost loan or not a high-cost loan. And I think Larry, as a lawyer, would probably agree with that. But on the ATR, I don't think anybody can definitively say that. And, you know, TPR firms that actually do the diligence, you know, they'll tell you that it complies with underwriting guidelines and they were done in good faith, but they can never give you a certification that it is actually ATR compliant.
Yep. So Lindsay, the mortgage insurers have some experience with mortgage credit risk. I think they price manage and attempt to look at that every now and then. You all actually rolled up your sleeves and put together a compensating factors proposal that said, okay, 43 DTI, that's too bright of a line, but tell us a little bit about what USMI came up with and why.
Sure. So in our comment for the advance notice of proposed rulemaking, we recommended that the Bureau establish a transparent underwriting standard defining QM status with a list of mitigating underwriting criteria, or these compensating factors, for loans that are above 45% DTI ratio and up to 50%. It's essentially what's in the marketplace today that the GSEs use under the patch. So you're just expanding it, you're making it applicable to our market channels, and you make it transparent, which we think is really important. We agree with a lot of the stakeholders who commented and said that DTI is not the most predictive factor, especially when you compare it to LTV and to credit score, but it is very correlated, and importantly, it measures ability to repay. So we think that it's really important as a factor to keep included. It also serves as somewhat of a bright line. People have been using it in the marketplace to date, so we all know what that looks like, and if you're above a certain threshold, as is in the marketplace today, you know that there's going to be mitigating factors, at least under the patch, for those higher DTI loans. And what we found is, at least looking at GSE data and MI data, on those higher priced, on the higher DTI loans, those that are 45 to 50 actually performed better than those at 43. So just evidence that those factors are extremely meaningful. We don't have a list, a transparent list from the GSEs about what those mitigating factors are, what those compensating factors are that they use. And obviously they plug them into their AUSs. But we were largely able to back into some of these factors, and we looked at them, and there are things that we know that lenders use every single day. They're pretty common sense things. Minimum down payment of 5%, credit history that meets certain criteria, including, you know, no 30-day lates on real estate for the past 12 months, 3 months minimum reserves in the bank, and a limited payment shock. And we provide a lot of detail and a lot of rationale within our comment if you have interest in looking at it. But these are all measurable things. They're all things that lenders do on a day in and day out basis. The approach obviously allows for a manual underwrite, or it could be plugged into different AUSs, including new multivariate models, not just DU and LP. We think it's the best approach in that it also allows for innovation, because you define a broad QM box and players can play within that box. But it also serves as sort of a credit risk baseline, and this as a set of guardrails for mortgage credit risk. So I think that that's something that would extremely benefit the PLS market. Moody's recently wrote a piece, I think just last week, talking about the non-QM underwriting practices and the lack of uniform compensating factors in that market as being a concern that they've got. So we think that in the QM space, it's absolutely going to be essential if you want a healthy PLS market to exist, to have a transparent, consistent set of compensating factors out there. We also think that it's a really important approach for leveling the playing field. And this is something that the administration and the Bureau have stated that they really have a concern about, is leveling the playing field between the PLS market and the GSE market. We have concerns with removing DTI altogether and leaning, for example, just on the provisions in statute and the safe harbor at APOR, because you will start to see some unevenness in the market. FHA uses compensating factors. They're obviously different than what's used in the conventional market, but that's okay. At least you're measuring apples to apples. They also, their calculation for APOR is different, so that's going to have to be addressed. But the second thing is the GSEs are still going to use compensating factors, even if the Bureau decides that they're going to do away with DTI altogether. The GSEs are still going to use compensating factors. They won't be transparent. They'll somewhat be at the whim of the director of FHFA. And the PLS market, I think, will continue to suffer because they're not going to have that same set of underwriting guidelines.
Well, it's a thoughtful addition to the discussion, and so we definitely need to rely on the MI's experience as we figure this thing out and try to build towards a market that can, as I said, self-govern and grow. Of course, Jeremy, economics matter. You've been in secondary marketing since you had hair down to here, just like me.
Since I had hair.
When you look at best execution options, when you look at the choice of going through agency versus going through PLS, PennyMac isn't afraid to try out new structures. PennyMac has never been afraid of using innovative secondary market financing techniques. So what do you, as representing an organization that does try and be innovative in how it looks at loan execution, like where do you see the state of the PLS market? What are the barriers, and what should we be talking about?
Actually, before I answer that, I wanted to circle back real quick on the previous comment and add a little bit of clarity there. I think from a QM perspective, it's really important to realize that I think it's a dangerous path to go down to use pricing to set the QM. That relies on lenders correctly pricing credit risk into the mortgage. And as Michael said, I've been doing best execution and mortgage pricing for quite a while. I've built a lot of rate sheets. I looked at a lot of rate sheets. I dealt with a lot of fulfillment teams and sales teams, and they're just, pricing is not that granular. And there's never more than usually one or two dimensional grids. The way in which they handle layering of risk is extraordinarily basic. So I think it's a really dangerous path to go down in setting QM based upon pricing. Additionally, I would say that APR, the unfortunate thing about APR is it includes a lot of other components that aren't credit risk related. A lender's margin, for example. So you potentially have some disparities across lenders who may require higher margins than others just because that's their business model. So that all gets tucked into APR too. So you might have two borrowers walk into different lenders, and one happens to be non-QM and one's QM just because the one lender requires more margin than the other. So also an issue with using pricing to drive QM. And the last thing I would say is the most dangerous piece is that lenders can manipulate APR, issue lender credit, so you can convert a loan from non-QM to QM, a QM loan simply by issuing a lender credit, which to me doesn't make a lot of sense. So from my perspective, it seems like the QM status should drive the price, not the other way around. So now I'll go.
Yeah, now you can answer
What was
the actual
question
question I asked. Economics in the PLS space.
So it's whoa, sorry about that.
God's mad at you
It's
for
been
not
it's
answering.
been quite a while since then we've issued a PLS, but we've continued to look at it for quite some time. And we, being an issuer and a servicer and a credit risk investor, we would love to see this market flourish if it's done responsibly. So to attempt to answer Michael's questions, I'd like to go through a quick comparison of a GSE and PLS execution. So as Michael pointed out kind of at the top of the meeting, that the GSEs have created and standardized origination and servicing guidelines, a rep and warrant framework, a QM process. And these standards, I think, are really one of the most important contributions the GSEs have made in recent years, and coupled with the QM patch, have provided a tremendous amount of certainty and efficiency for originators and sellers. What's more is that they've maintained these guidelines over time and enhanced them. So the GSEs have also invested heavily in technology, which has also brought about additional efficiencies and certainty. Things like income and employment validation, collateral underwriter. So these technologies that allow the lender to get day one relief on rep and warrant relief. Appraisal waiver technology, which allows for large swaths of refinance loans to get done with no appraisals. And data validation tools like Early Check, which allow lenders to identify discrepancies and inconsistencies in flight during the manufacturing process. The GSEs have also provided certainty around pricing as well. The very liquid UMBS forward market and their published LLPA grids provide lenders with near certainty around pricing. The GSEs have even enforced standards on the MI industry, helping to align the origination and servicing guides across the 6 competitors that compete in that space. So all this standardization has brought about incredible efficiency and certainty in that GSE execution. On the flip side, the PLS space lacks much of this efficiency and certainty. There's no clear standards for meeting ATR. Appendix Q was more prescriptive, but it hasn't been maintained. And there's no universal rep and warrant framework or universal servicing guides. There's less alignment across the MI space for loans not sold to the GSEs, and the diligence costs are significantly higher on the PLS side, in part due to the lack of standardization that occurs in that space. As an originator, PLS pricing is much more opaque. There are no published LLPA grids. There's no clear picture of how an individual credit attributes influence the subordination levels. This is especially problematic if QM is driven by pricing. So many of the benefits of the GSE technologies, such as DU, LPA, CU, early check, appraisal waivers, day one certainty, are also lost in the PLS space, most of which are lost. So it's a far less efficient execution compared to the GSEs. So with regard to economics, there are pockets of the GSE space where the GSEs have higher LLPAs, which represent some opportunity in the PLS space. And if G fees are edged higher, more and more of these pockets will develop. The irony here is the GSEs need these high margin products to subsidize their higher risk products to meet their duty to serve goals. So it'll be interesting to see how the FHFA addresses that on a going forward basis. So at PennyMac, we've looked at certain segments of the non-QM market, of the non-agency market and even the non-QM market a bit. We've considered bank statement programs, but just couldn't get comfortable with them, in part because of the lack of clarity and certainty on whether we could meet the requirements of ATR using bank statements. What we do believe in are standards. So our current non-QM program employs the GSE AUSs because we could get comfortable with that AUS coupled with the origination and documentation standards of the GSEs would be defensible for determining a borrower's ability to pay. So lastly, how do we see all this changing? So in our view, the PLS space would benefit from a governing body that sets standards for the non-agency space. So, and I think many of the standards that I mentioned, I think these standards should include many of those that I mentioned: origination, servicing, reps and warrants, MI. This will help close some of the efficiency and certainty gap to the GSE execution. There are various levels these standards could exist, from very prescriptive, to swaths of the market with statistically proven performance records for industry participants who want a little bit more certainty, all the way to the other end could be some minimal set of standards to provide some basic guardrails for new processes and techniques to allow for some managed innovation. And finally, there would need to be some type of feedback process to allow these new techniques, once they develop and prove their track record, to be incorporated back within the prescriptive standards. So the other thing I would mention is if the QM definition goes down the path of APOR versus APOR, I think the industry participants would need some additional standards other than just APR to help mitigate the risk of a legal challenge that they somehow mispriced the credit risk or manipulated the price to achieve QM status. And taking this all a step further, the governing body could build technology like an AUS type of model to provide originators with real-time feedback and certainty while the loans are being manufactured. This technology could facilitate the integration with approved third-party providers to provide real-time data validation and give others further downstream in the process more certainty as well. So all this still leaves some of the economic challenges of the PLS execution relative to the GSEs. So we'll see what happens, but the FHFA appears to be backing off some of the let's shrink the GSE footprint rhetoric and the CFPB seems willing to go down the path of APR versus APOR for QM. And there doesn't seem to be much political will to raise G fees, and then coupling that with the UMBS market continuing to support a very large liquid TBA market. So all this points to a GSE footprint about as large as it is today in our view. That said, I do still think it's worthwhile going down the path of standardization in the PLS space. I think it's an important step to allowing it to flourish again.
Okay, Andy, thank you for that, Jeremy. So Jeremy talked about a governing body, talked about standard setting, talking about some governance. So we're all using the same terms. Is this possible? Is this something we can do? And if so, how?
Yeah, I think first, let's think, why do we need this stuff in the mortgage market? Like, why is there a need for governance or standardization at all? And so if you think sort of fundamentally about mortgages and the process, what we have is tremendous separation between the people who originate the loan, so the loan officer who's talking to the borrower, or the computer screen that's gathering data from the borrower, and then the person who's investing in that loan. So we have, a range of those people on the table here with us today. And so there's information that's gathered at the origination side that isn't necessarily available to the investor. Particularly if it's like consider, it's pretty hard to know what someone else considered, even if they write down, what they said they considered. So one, there's that difference, separation of origination from investment. The second is that there's a big separation in time from when loans are originated to when losses appear, right? So it could be several years later that you see the loss, right? It might take an economic event, like some loss of job or change in home prices, before you find out that these loans actually weren't made all that well. And the basic regulatory scheme that we have in the PLS market is one of disclosure, right? So you're supposed to pass information along. And, so that has some limits. So, I thought of sort of an example, like an analogy to think about. Suppose you go to the grocery store, or you go to like your local corner fruit guy. You say, okay, well, I'm going to buy two things. I'm going to buy some fruit, and I'm going to buy some meat. So you go to the fruit stand guy, and you pick up a banana, and you say, oh, this looks pretty good. It's yellow, and it's not brown. He said, oh, I can probably eat that. You can even open it up right there and eat the banana. And your chance of getting sick from eating a banana that you looked at is extremely low. So now suppose you go over to the butcher counter, the meat counter, and they have two kinds of meat there. They have USDA meat, and they have non-USDA meat. Who here is buying the non-USDA meat? So USDA meat is exactly like what we're getting from the agencies, right? So there's inspectors who actually go into the, where the carcasses are cut and actually inspect the entire process, and then they're tracking every piece of meat through the system to make sure that it's shipped correctly and always at the correct temperature and everything else. So when you buy meat, which is separated in time and in space from where it was created, you're protected. And so really that's what we're sort of facing in the mortgage market. As an investor, this is more like buying meat than buying fruit. That you can't just look at a piece of fruit, a loan file, and say, was this loan file, especially you're not even getting the whole, look at a tape of 15, 20, or even 100 fields and say, was this loan originated correctly? And so really that's what drives the need for these standards and for the governance. And really the question is like, who should do that? Should it be the government making that requirement? Should it just be each investor negotiating separately with investment banks and with originators as to what process they want? Or is there something we can do together as an industry to set some standards? And my view is that there's a lot that we can do. So we can't do everything. The disclosure is still important, but there's probably big steps that we can take, especially on the data-driven side, to say what underwriting techniques have worked, which ones haven't worked, and sort of like set up a little bit of a spectrum from, oh, these are good. If you do these, it's very likely to work out. There's no evidence to support that they do help the process. In fact, they may not help the process at all. And as an industry, we can gather that data, report on that, and then come to creation of some standards. And then the big question is, who's going to enforce those standards? And so then that would be the next question. Is this something that's going to be voluntary? Is it something that will have a good housekeeping seal? So it would say, SRO, non-SRO loans, so these followed the SRO standards. Or would CFPB or another government agency adopt this, industry organization and say, yes, it's like FINRA, you follow the rules or there's enforcement that comes from the industry group. So we can see which way that goes. So just like any good candidate, I'd like you to go to, not my website, but actually Michael's website, not michael.forpresident.com, at least not this year, but the structuredfinance.org website, and look for the blogs, and so it's a little more detail on what I just talked about is listed there.
Yeah, so, we really are attempting to facilitate this conversation. Andy has done some good blog material, and we're going to keep, pushing that to facilitate it. But, on a retail level, I haven't yet done a meeting with either an issuer, an investor, an MI, anyone, and said, hey, what if we built some standards ourselves? And it could be any legal extreme to like, this thing is actually blessed as being USDA certified because this group did it, or it could be a gathering place for best practices where we actually just talk about what's going on and what data we're seeing and like how can we prevent the market from sort of all gravitating in a negative way together. But it's been like hauntingly supportive. Like no one's saying no. I keep waiting for someone to be like, no, that's a terrible idea, don't do it. And it doesn't seem to be happening. So we'll keep pushing it. And I definitely recommend everybody here to look at the stuff that Andy's putting up, and that as we host these roundtables where we're discussing about PLS governance, please come to the roundtables and discuss it with us, because we're really talking about nothing short of trying to build this market out and self-regulate and self-police so that it's not then forced upon us, and that we can actually stay ahead of trends that are problematic. Rajiv, looks like you have something to say. Maybe Larry does as well.
I was trying to take Andy's analogy a little further. If it's in fact USDA certified, the analogy would be CFPB certified, right? Because that's the U.S. government arm effectively that does it. So the question is, if the industry does self-governance, unless we actually get it validated by the CFPB or a comparable agency, but I think we're really talking about the CFPB, have really achieved anything. Clearly, it's all good intent, but otherwise, I think we're still exposed, and curious to hear Larry's views on that for things that may be second guess.
Yeah. Larry, did you have something you wanted to?
I was just going to ask if we could extend the analogy to a qualified burger and a non-qualified burger. No, but you're right. I mean, the industry standard is certainly helpful, but unless it's sanctioned by the government, then there's still a legal issue and a factual issue on what does it do. So I think it's really good from an investor perspective, and it helps create that kind of transparency that's important. From a legal perspective as to whether it's a qualified mortgage or a non-qualified mortgage, unless that concept is incorporated into the regs and given, and if you will, sanctioned by the Bureau, it doesn't really have any legal effect.
Pete?
So no, I was just going to add to this. I think it's a really good conversation. I mean, I teed this up, talking slightly pejoratively about the first rulemaking, but I do think we walked away with some important lessons learned from it, which is that, I mean, the patch was terribly unfair, but it did kind of create this, it undoubtedly created standardization in the system, standardized underwriting criteria, standardized full documentation guidance. That then, once you had standardized rules of the road, you were then able to create standardized data around the UMDP and MISMO framework that created unprecedented levels of depth and breadth of quality and integrity of data. That begot huge data mining, big data warehouses where you could mine that data, come up with process automation, technology innovations, efficiencies, and that is just good. This eliminates friction in the system, improves liquidity, good things happen. And so we learned that lesson. Then we learned with Appendix Q, as lousy as it is, that when the CFPB tries to define rules itself, it doesn't work out too well. That administrative fiat is not a good way for it to work. This notion of something in between, where there's an organization that can kind of develop a base of standards that the Bureau could then kind of bless or adopt, might be a nice middle ground.
Yeah, I mean, that's kind of what we're going for. Andy, did you have something you wanted to add, or?
Yeah, so, part of what the organization would do is just gather the data into a central place for discussion, and then it's not that clear, like would the CFP be adopted or not adopted, but without doing that, there's really no chance of the industry really having the voice that we would want to have on setting standards, because otherwise it's really just coming from disparate places using disparate data, and so there's not sort of one voice saying, these are things that we all agree work, these are things that we all agree, don't work, or at least don't add much value. And so that would be to introduce the conversation. Also, in the law, there is some idea that if you can show that you've done the analysis and can support your approach, right, that it's a data-driven standard, that it's supported by historical data, there is some legal protection associated with that, I believe. And so at least there'd be some move there. But I think the point that it would not be QM safe harbor without some blessing from some government agency is true. And the question is, do we want to go that far, or would we be happier in the middle ground? But I think we're not happy in the current situation where everyone's making up their own standards, which, continuing my analogy, suppose like on the back of every package of meat, there was like a list of what steps that particular processor used to keep that meat safe, and like which trucks it was on as it went from Nebraska to California or Nevada. Like, just because it's disclosed doesn't mean you're going to know what to do with that information. And so I think we need to move beyond disclosure into some sort of standards that we all can agree on.
Yeah. Andy's actually a vegetarian, so I'm not so sure why. So there are PLS deals getting done right now in the 144A space. Nothing in Reg AB2, but the SEC is looking at opening up Reg AB2. Does it matter if it comes through 144A versus the public shelf? Does anybody have opinions as to whether that sort of standardization would be helpful from that regulatory body? Anyone in the audience have any opinions? It was on your list of questions to prepare for. I didn't think we were going to get there. I think it would be good to have Reg AB2 work so that we all have standards and we can actually do cross-comparison of like-minded data fields. So I actually would say that for those of us who want to have a vibrant PLS market, the SEC has opened a comment period to look at the Reg AB2 fields. SFA is literally going through a little over 200 data fields and looking at them one at a time to say there are some of them that are irrelevant, but that's whatever, it's just a nuisance. But there are some that are completely impossible to collect and to provide. And so we're kind of going to go to the SEC and say, look, here are 20 fields that have critical definition errors that you cannot provide this. So can you please remove that from the required data element? So that's the.
But Michael, to your point, other than sort of the burden of complying with Reg AB2, which I think you're highlighting, even if deals got done under Reg AB2, I'm not sure it essentially addresses the question of if the underlying assets were AGR compliant. All that it does, it
unifies the data.
It brings into conflict two different government agencies, the SEC, under whose regulations you issued a deal, and the CFPB, under which the underlying loans were originated.
Yeah.
Well,
You're the data guy.
Well, no, yeah, I was just going to say that, this is back to this kind of continuum, that if there's standard rules of the road and standardized data sets that, that an end investor can rely on from first application all the way through delivery, all the way through securitization and disclosure, that should just create a better system. And then if it's, I don't know what the liquidity distinctions are. It would strike me that Reg AB2 traded deals would probably be a more liquid market if they were, you could rely on them.
Well, look, as I said, this session will be up on our site. We're videoing it, so I encourage you to go to our site. We're adding a lot of content right now, especially in the residential finance section. If you are interested in joining our QM task force to be part of this process of building out industry self-governance, please email me. Dallin is our actual point of contact. All of it's on the website, so it should be easy to navigate. I thank the panelists for coming and for sharing their views. Appreciate everybody's time, and have a great afternoon.